What has been done will be done again and again and again.
You were listening to Wealth Talks with the McPhees. We're sitting here in the studio today, and boy, do we have a lot to talk about with all the banking news that has been going down here recently.
Oh my! It's just a repeat of what has happened in the past, and they say if you don't learn from history, you will doomed to repeat it, and maybe even worse than you did before.
Well, it sure seems to be, here as we've watched over the last few weeks, you have the Silicon Valley Bank fail, and then you have Signature Bank fail, and now it seems that Credit Suisse in Europe might be in financial difficulties. But we've seen this type of thing happen before. We saw some banking failures back in 2007, 2008, and even before that, you had economic failures, business failures. That the government has been tempted to step in and bail out. We've seen that a number of times.
The too big to fail attitude that says, oh, this is going to affect too big of a sector that we have to step in and bail out. And so when we did bail out Lehman Brothers and AIG and GM Motors and all those people back in 2008 because of their mismanagement of our money and our resources, the government was on the hook at that time for $498 billion. Now, President Obama said in 2012 that the government got back every dime spent on that. And yet, according to MIT of the Sloan School, they're saying that we have now currently spent $4.6 trillion, that's with a T, not a B, dollars in that bailout. So that's what it's really cost the American taxpayer.
Yeah, I was just going to say, you're talking about the government says they're getting it all back, which you just said they haven't. But even if they did, where did it come from? It didn't come from the companies they bailed out. It's coming from you and me, the taxpayers.
And of course, our president today said, not one dime of American money will go to bail out Silicon Valley Bank. Well, where are they going to get the money to do it if there's not going to come? Because governments produce nothing. They only can tax.
Yeah, and they stepped in and they said that, I think it was like 95% of the deposits in the Silicon Valley Bank that went under were uninsured deposits. Yet the FDIC and the Federal Reserve System, they're stepping in and saying that depositors won't lose any money. Where are they going to get the difference from?
Well, and they were supposed to cure that last time we had the Great Recession in 2008 because the FDIC bumped up its insurance on depositors from $150,000 to $250,000, and that was supposed to be adequate. But it wasn't, was it?
Well, and there's some misunderstandings because some people think, oh, for every account I have at that bank, it's insured for $250,000, but that's not the case. It's all your accounts at that bank combined. Only $250,000 is covered.
So let's talk about bank failures. They're fairly common. In the last 20 years, there's been over 400 banks that have failed.
Wow.
And yet, since 1991, and that's going back, 30-some years, only 7 life insurance companies have become insolvent, and nobody that had money in those life insurance companies lost money.
So,
what a difference.
Yes.
Big difference.
Now, why is that? Why is it that life insurance companies can manage money much better than banks can?
Well, for one, they have to keep greater reserves. And depending on the products that they sell, they have to keep more reserves for some products than they do for others.
And whole life insurance is one of those products they have to keep the reserves for.
They have to keep a lot of reserves for whole life insurance. In fact, that's one of the reasons behind some of the push. I think we talked about this maybe in a podcast last week about why insurance companies like to push IUL products.
Exactly.
Because it takes the risk off of the insurance company. They don't have to keep as much money in reserves for those types of products.
I was just talking to an agent or a representative from an insurance company the other day that was trying to sell me on selling more IUL. And I said, well, I've never sold an IUL policy yet. Because he says it keeps the insurance companies in a position where they're not so much at risk because they don't have to put that money. They put that risk right back onto the policyholder. And so, hey, if your IUL policy doesn't perform the way the insurance company, they're off the hook. It's your fault. It's your responsibility. That's what the whole policy was designed to do, is to split the risk away from the insurance company and leave it with with the policyholder. Very similar to what's happening here is, the government's stepping in and say, okay, we're going to make this taxpayers pay all your problems, banks, because you were poor managers.
Yeah, so with the insurance companies here, when they're keeping larger reserves on the products they are selling or shifting the risk back to the customers with the risk that they aren't keeping on these IUL products, it makes the, having greater reserves like that makes the insurance companies better able to weather a storm, which is why we only have those 7 life insurance company failures versus how many bank failures did you say?
There's well over 400.
Yeah, so a lot more bank failures than there are insurance company failures.
Well, and
when an insurance company fails, it's not the FDIC or the government stepping in to make depositors whole. This is something that they have. Insurance companies buy reinsurance, so other insurance companies will step in to pick up the slack. And if there is still something left over, then you have the state level insurance guarantee funds that step in to help with the administration of that.
And those guarantee funds are run by nonprofits, and they're volunteer. But every insurance company that sells insurance, life insurance, belongs to those state guarantee funds. So it's not government run. It's something. Hey, we're going to step up here. We're going to take care of our customers. We're going to commit to funding these nonprofit guarantee funds so that if something does happen and the reinsurers or the state commissioner can't slip these contracts to someone else if we're insolvent, then the guarantee fund is going to be there for.
So, and as far as those reinsurers, they don't just appear if suddenly an insurance company is going insolvent. They work together all the time. So I remember seeing one insurance company that we represent. They had like a list of 20 or 30 reinsurers. And then sometimes when we submit an application to underwriting, the underwriting will look at the case and they'll realize, we couldn't really accept this case right now because what else we have on the books? The people might be insurable, but we can't take this risk. So then they'll say, hey, we're going to shop our reinsurers. So then they go to their reinsurers and they say, hey, here's this case. Can you back us up on this? And if they will say, yes, we'll accept that, then that in the insurance company that's doing the underwriting, they can then issue the policy with their name, knowing that their reinsurers are supporting them. So they stay accountable to each other. So like in 2008, when AIG went insolvent, nobody lost their policies. And I still talk to people today that say, oh, yeah, my insurance company, I have insurance through AIG. Oh, wait a minute, I think it's now blah, blah, blah. And I still hear that today, all these years later.
So let's touch on why the federal government had to bail out AIG if the reinsurers were there. It wasn't because AIG's insurance division was mismanaged. It was because at that time, it was before the Frank Dodd bill happened, insurance companies could act like banks. And AIG was investing like a bank does in subprime mortgage real estate. Yeah, and that's what that's what caused the 2002-2008 crisis in the first place.
And they were actually underwriting what were the credit default swaps. And so, when the banks would create these derivative products based on subprime mortgages, then they would underwrite those with insurance against failure. And so AIG was insuring these derivative products that were leveraged several times over on the subprime mortgage stuff. And so that's why it created such a huge failure, because they were based on all these pyramided derivatives.
And here's the crazy thing, John and Michelle. Barney Frank, who was the senator on the Frank-Dodd Act, was a board director of the Silicon Valley Bank. So he lobbied Congress to be exempt from the Frank-Dodd regulations for the SVB Bank.
Interesting.
And so, it just makes sense that this bank is just off the rails.
Yeah, I feel like hitting my forehead with the palm of my hand right now. So another crazy thing is back when AIG had their failure, just months before that, they were giving a AAA rating. That reminds me of what's happened recently in this bank failure, where people were saying, "Hey, invest in this," and there was a lot of promotion of investing in that bank when it was, and some of the leaders taking their money out, some of the people up at the top, while this is in motion to collapse. So it's incredible.
This reminds me of scripture where it says, up until the day, people will be marrying and partying and doing all this stuff, and then the Lord comes. And, this is what happens in all these crashes that we've seen. Everyone, go back to the 20s, everyone was just having a roaring 20 time, That's what it's called, the roaring 20s. And bang, then the stock market collapses. What led up to it? In Rome, they were having these elite orgies and everything, and then bang, it just collapsed. It's because we get into a place in society where we become so materialistic, and the leaders become so corrupt that monetarily they just can't hold up to it. There's only so much opulence that a society can experience before it collapses. It goes back to the very essence of God putting Adam in the garden to work it. And today, there's so many people that don't want to work, and they get into positions of political power, and they siphon off the people that do.
Mm-hmm.
Yeah, that's not good. Well, John, you thought of another piece of history in the American history where government was stepped in to do regulation. So
yeah, this is the 2007, 2008 was not the first time that government thought about stepping in to bail out too big to fail companies. Going all the way back to the era of our founding fathers. We're hosting a Constitution course here recently for a number of our clients across the country. This is not the first time that we've been to this course. We've hosted it a number of times over the last couple of years. And one of the stories that they go through, David Barton and Rick Green during this course, is they talk about the Codfish Bill back in 1791. So you think about this, the Constitutional Convention happened in 1787. You had you had that ratified then. I think it was by 1789. Then we started to have a federal government functioning in the United States. And then 1791, just a couple years later.
That's 2 years later.
Yeah, you have the Codfish Bill come along. Now, what was the Codfish Bill? Well, it turns out the state of Massachusetts was highly dependent on the codfish fishing industry at the time. And you have to understand, Massachusetts was the economic engine that was driving a big part of America at that time. You had different industries around different places, but Massachusetts is really a powerhouse, and they're dependent, so many of them, on the codfish industry. Well, for whatever reason, the codfish disappeared. They were not being able to catch the fish they usually did, and so the fisheries were in trouble. And you can see this even today in the Massachusetts legislature. Their seal has the codfish on it, so still hanging there, harkening back to these roots. So, codfish industry is having a big problem. This is the AIG, the big industries back in the day.
Uh-huh.
And so, when they're having this problem, they say, "Oh, well, we need a bailout from Congress." And that first Congress that was very in tune with our constitutional principles said no, because if we bail them out, what's to prevent us from bailing anything else out and basically having government take over the private sector? And so they said no to that.
Oh boy. And so then the whole economy collapsed and America just never became anything, right?
Well, obviously that's not true.
Yeah, so no industry is really too big to fail. Men and women have creativity given by God, and when one area collapses, they can think of other ways to work together to use resources and be resourceful and create.
Well, the Founding Fathers intended to protect the general welfare of the population by creating independent rights and not protecting special rights. Mm-hmm. And that's where the term crony capitalism has come from, is when these too big to fail companies think they deserve a bailout when, Joe Blow down here on the corner that starts a business and fails doesn't get that same. Capitalism rewards those who manage well and it disciplines those who don't. And when government or a parent steps in to protect their child or their little baby from being punished by, natural law, guess what? Everyone suffers. And that's what we have come. Now, that's why we're so fond of mutual life insurance companies. They're a group of people that are mutually bound together that are trying to accomplish true capitalism, not crony capitalism. We don't want the federal dollar. We don't want the taxpayers' dollars. We know that if we pool our money together, we can get a steady, constant, dripping return that will build over our years. And then when we need, we can leverage that money and borrow the reserves of the insurance company.
Yeah, so a question came in this week. Says, given what's happening with these banks failing, it makes me wonder how safe my money is in my savings account.
Yeah.
And
are you too big to fail?
Or we're gonna talk about this a little bit on the podcast. So what is, there is uncertainty with these bank failures happening. You wonder what's coming next. And so what are some things that that give us stability during these times of uncertainty?
Well, I think first of all is where are we putting our trust? Are we putting our trust in our money, in our reserves that we're building up? Because the scripture tells us that money will make itself like wings of an eagle and disappear into the sky just like that. So if we're putting our hope and trust in how much money we have and that we've got enough, what in the world is enough? Mm-hmm. We have to understand that money has to flow in order for it to be valuable. Because $1 today is worth more than $1 is going to be tomorrow because of the inflationary practices of the government. It's just that's just a natural law. We can't dispute that. All right. And so then the second thing is where are we putting our money so that we can use it as leverage to use even more money? And that's the whole idea around solid capitalistic banking. And yet the banks, for example, Silicon Valley Bank, they were lending out $185 to every dollar they had on deposit. That's not good leverage.
Yeah, that's not good banking.
When we borrow from our life insurance company, we can only borrow $1 for every dollar of capital that we have. Now, our capital doesn't go away. It keeps earning a return while we do that, but it's a 1-to-1 ratio. And so when we use our policies to access the insurance company's reserve money to use, it's a 1-to-1 ratio. The risk is very, very, very low.
Yeah. So they're not leveraging themselves at such high levels as these banks are.
No, and that not only helps us personally, it helps all the people that the insurance company has deposited our premium dollars with because they're able. So we are actually stimulating true capitalism, not this crony capitalism that many banks are responsible for.
So a lot of times people say, oh, I like this becoming your own banker, the infinite banking concept, bank on yourself. I want to be my own bank and have my own money, and I'm not going to need to use banks anymore. Well, we still live in this world. We still breathe oxygen. We have to use banks, as a way to facilitate the money coming in, money going out. But that doesn't mean that we need to keep a lot of money in the bank. And so if we're just using it as a place for transfer, going in and out, kind of like using a train station or a subway station, an airport, we don't live at the airport. We just pass through the airport. So if our money is mostly just passing through, we've got enough there to meet the demands of what's coming in and going out, but not just parking it
stored there,
then we're going to experience less loss if a collapse happens at our bank.
Now, Michelle, you were talking to someone yesterday, and this is a repeat of what's happened in the past. We saw it happen in 2008, and it's happened every time, where people have a loan out, and all of a sudden the interest starts getting higher on it.
Yes, actually, I've talked to 2 people just in this week.
And this happens with velocity banking, the big term out there where you borrow money against your house in a HELOC, and now you pay it back and whatnot. Well, what happens if that HELOC interest rate goes up? Because that's not a fixed rate. And that's what's happening to so many people today. In life insurance, that doesn't happen.
Yeah.
There's a limit to what the insurance loan rate can be. It's what that is. It's capped at certain points. So it's
Yes, and in this specific example, the person was contacting me. He's going to take a loan from the policy, and he said, I have borrowed money elsewhere, and just last April, it was at 3.88%. Well, that's a good rate because from the policy, he could get it at 4.4%. So he took that lower rate. But he said, then that was just last April 2022. In January, it went to 7.6. So he started thinking,
Wow.
maybe I need to change what I'm doing here. In February, the very next month, it went up to 8.14. That's why he was calling yesterday to take a policy loan. And as we were talking through the process, I said, now be aware that the insurance company is currently taking 20 to 25 business days to process these loans. And he said, yeah, I am aware of that. And I've already done the math. It's going to cost me $10 a day until I get those loan funds.
And that's on that 8-point-some-odd interest loan that he's already got outstanding that he's
Yes.
going to refinance with a policy loan.
Yes, and hopefully it doesn't go up before that policy loan gets in because otherwise it's going to adjust the numbers. And it's interesting, just the day before, I've been talking to another client, different part of the U.S. They had also borrowed to make some sort of an investment they were doing, or maybe they were doing the velocity banking type idea. But and again, it started last April, but the interest rate went up to 7%. And he quickly realized this is not the spread that I need for the deal that he was doing. And so he had to rectify that through reallocating his funds. So, you have to make good judgment about this. If you can get a loan that's cheaper than your policy loan, hey, use that. But, if times change and you have cash value available to you to use, then you have options available to you that the average Joe is not going to have because they don't have whole life insurance.
That's right. And if you look back at the crash 1929 through the Great Depression, people used their life insurance values when the money at the banks was not available. This is a great resource for cash reserves during times of uncertainty. And you mentioned just a couple minutes ago, Dad, that the interest rates at the insurance companies are capped. So let's talk a little bit about how they are capped, because some insurance companies have variable loans, some have fixed rate loans. The fixed rate loans are going to tend to be a little bit higher interest rate. So some companies have a fixed loan rate about 5% right now. Some have a fixed loan rate at 8%. Back in the 1980s, when Nelson Nash was was facing interest rates at 23% on some of the real estate loans that he had, he could access money from his life insurance policies between 8 and 11%. So the insurance companies, their interest rates were higher at that time than they are today. So how do insurance companies change their interest rates over time? Well, they can change it up to 1% per year, according to some contracts. So a variable loan rate, if it's 5% this year, it might go up to 6% next year. That would be the maximum that they could change it, and then it might go up, they could raise it a percentage point after that, but it gives you a little bit more time, and it tends to lag what's happening with interest rates other places in the market.
And that's different than the example I just gave, where in less than 12 months, like 10 months, it went up almost 5% on this guy. So that's a big difference.
A big difference.
And most insurance companies that we use that allow you to borrow the insurance company's money are limited to how much they can raise their interest rate based on what their portfolio is earning. So they can only raise it 1% more than what they're earning in their portfolio.
Okay.
So that keeps interest rates lower than when the Federal Reserve meets together in their Candlestein operation and say, oh, we're going to raise the interest rates by 75 basis points.
Yeah, so that's a cap on it as well, because if they can only go 1% above what they're earning in their portfolio is going to take a while to adjust because they're buying a lot of these long-term bonds.
That's right, and that's why the life insurance stays more stable in volatile times than other types of places where you can keep and store your money.
That's right. So lots of options during times of uncertainty when people have life insurance cash values that they can access, specifically whole life insurance cash values, because we talked about how the reserves on the indexed and universal life insurance products, how those don't tend to be as steady as the reserves that insurance companies need to keep for whole life insurance policies. These are great reserve during times of uncertainty. Our clients are using them. We gave you a couple of examples of that today. And if you want to find out how you can maximize this foundation in your financial life, give us a call at 702-660-7000. We're here to help you. Have a wonderful week, and we'll be back next week on Wealth Talk.